Welcome to Anatomy of Your Financial Statements. This is going to be a quick overview of some of the key components that financial statements contain. There's a lot more complexity that we could go into here, but we'll do that in a separate video. So here we can see that we start with our trial balance, and that's going to be right here at the top. And the trial balance is going to contain all the accounts in your accounting system. So you think of your bank accounts, accounts payable, inventory, your sales, your expenses. All of those accounts are going to be contained in your trial balance. Then the trial balance is broken into two components. There's the balance sheet component, and then there's going to be the income statement component. The critical thing to keep in mind here is that your balance sheet is at a point in time. So it's showing numbers that are at, say, December 31st. Then it's only numbers at December 31st. So that's where, like your bank account, it has a balance at December 31st. Now your income statement, it's a period of time. So it would cover January 1st all the way through to December 31st. So looking at your sales over time, what were my sales for the year? This is very critical to understand this, that balance sheet is point in time, income statement, period of time. After this, both of these, both the balance sheet and the income statement, are further broken down into more components. So here on the balance sheet, we have assets, which is going to be what you own. You have liabilities, that's what you owe. And then equity, that's the remainder. So it's going to be the difference between what we owe and what we own. Then on the income statement side, we have revenue. So this is revenue coming in from the sales that we're making with our company. We have cost of goods sold. So these are the costs that are directly related to revenue. Often when revenue goes up, cost of goods sold is going to go up in tandem with that. Then our last account here, that's overhead. And those are all of the other expenses. And often these expenses are more time bound. So if you think of your insurance expense, whether you do 10,000 of sales this month or 15,000 of sales this month, likely your insurance is not just going to go up directly in relation to the revenue, and you just pay that insurance once and then you're good for the year or for the month. First, with revenue going up, and if you sold another widget of some type and you need the materials in order to produce that extra widget, that's when it'd be cost of goods sold. So it directly or fairly directly correlates to amount of revenue. And then on the balance sheet side, when it comes to the assets and liabilities, then it breaks down even further into current and non-current. Before I get into that, you may be wondering what these account numbers were here for, or what these numbers were for. That was a spoiler. These are usually what the accounts will start with. So if you see on your trial balance, you see account 1001, you know that it's going to be an asset. If you see 2001, you know it's a liability. Sometimes the 5 accounts will represent both cost of goods sold and overhead, but in general, 1, 2, 3, 4, 5, that's what the accounts will start with, and often it'll be starting at 1,000 and going up, or maybe 10,000 and going up, just depending on the accounting system. So then with that, we have current and non-current assets, current and non-current liabilities. What this means is that current is something that will be converted to cash or something like that, or is converted to cash in less than a year. Non-current is greater than a year. So for example, a current asset would be our bank account. It's cash, we can access it. A non-current asset is going to be a truck that we plan to use over the course of the next 3 years. So it's not happening right away, it's over time. On the liability side, a current liability, again, this is going to be less than 1 year, and usually this could be an account payable. So maybe that insurance bill, we still need to pay it. We need to pay it at the end of the month. So we're going to be paying that with cash at the end of the month, which is less than a year. And then non-current is going to be greater than a year. So if you think of, you took on a loan of some type, and there's a portion of that loan that we're not paying until year 2, 3, 4, 5, that's going to be non-current. That's the quick overview of the anatomy of your financial statements. definitely a lot more complexity that we could get into here, and I plan to address that in future videos. A couple further spots you can go from this is checking out the financial statements video that I did, which looks at actual numbers in relation to this. You can study up on the matching principle, which is critical for accounting, and then also ensuring you understand double entry bookkeeping. But that's really getting into the nitty gritty. This is the high level overview. Thanks. Bye.